Welcome to Reality Podcast. I'm your host, Gary Scott. 4 times a year are 4 of my favorite reality podcasts. We take a look at the past quarter in the real estate market. We take a little glimpse into what the next quarter might hold. So today, my special guest who joins me at each quarterly update, say hello to Tony Jarrett.
Hello. It's good to see you, Gary. Thanks for having me again.
It's great to have you. You know, every once in a while, I'll get a text message or an email. Are you ever going to replace Tony as your guest? And I say, I'm not replacing Tony as my guest. You know, Tony, in our industry, 36 years. And I've had a chance to work with Tony for about 22 of those 36 years. And a couple of things. Number one, he's passionate about our business. Number two, he knows the numbers inside and out. And number three, he's pretty doggone good on the camera. So we're going to dive right into it. Tony, one of the things I want to do, a little disclaimer today, is that a reminder to all of our listeners, the real estate market, as you and I know, is hyper-local.
Yep.
We're going to make some statements about data, days on the market, months supply of inventory. And our statements are going to be very general. Directionally, they're correct. Could there be a subdivision? Could there be a school district? Could there be a zip code? Of course there could be. So one of the reasons we preamble that today is if you really want to know about your local real estate market, I would be remiss. Call your Howard Hanna real estate professional. Tony, let's get rolling.
All right.
Days on the market.
So before we do that, let me give you, to your point, an overall of the first quarter versus second quarter.
Perfect.
Second quarter was phenomenal. Specifically May and June. We had what I would call a late spring in our business. We typically see March, April, it starts coming. I don't know, I'm sure you all remember February 27th was a Friday. Mortgage rates were 5.875. We felt really bullish, and then 24 hours later, we had the Iran conflict happen. That changed some projections with mortgage rates, confidence, inflation, and everybody it seemed like in April just kind of sat on the sideline. The world reset, and guess what happened in May and June? It really came in strong. So I want to preference that for our audience because some of the numbers we're going to give you that we've seen regionally in all the southeast part of our where we serve is fairly consistent with that trend of a second quarter really doubling what we did in the first quarter, because the first quarter was just difficult because of that event. And with days on market, I will tell you what we saw was, for the first time in the second quarter in 3 years, I started seeing days on the market decrease.
Right.
And it was because of that momentum we saw in the second quarter. Now, I'll also tell our audience there's 2 days on the market. There's the days on the market that those properties that are selling hit the market and they move. It's right around 49 to 50 days is what I saw regionally. But there's another set of homes that are just sitting there, and you really could put about 1 additional month. And to your point earlier about certain price points, certain areas, it could be up to 2 months. Meaning if I can sell my house in 2 months, it might be 90 days, it might be 120 days. And there are 2 different markets we're seeing across the board. And that was a very consistent trend I saw.
Well, I think one of the things as we prepared for this, I thought, Tony, when you sent me the email and said, it really is a tale of 2 quarters. So yep. I appreciate you kind of confirming that. And I just want to echo, like June was the delayed spring market
right.
that we've all been waiting for. And I think what's really important is the interest rates did not drive it. The consumer behavior drove it.
That's right.
And as you said, for the first time in a while, days on the market went down.
Yep.
And yet inventory continues to rise. So that's one of the things that you and I talk about each and every time we talk about the quarter that went behind us and the quarter that's in front of us, is that we got to be very concerned about the media and the headlines. Particularly headlines of national publications.
Right.
Because they're giving a perspective that really needs to be drilled down. And so one of the things that is important to this podcast is we're going to give a very high-level regional update that is, as I said earlier, can be directionally correct. But again, go to your Howard Hanna professional, because that particular house or that particular market, particular subdivision that you may be concerned with or have a question about might be a little bit different.
Yeah.
So One of the things, we're going to talk about price changes at some point, but let's talk about inventory. And then I do want to talk about pricing because price changes, one of our branch leaders, David Ide, did a great exercise. I'm going to share some of that data. What's happening with inventory, number of homes on the market, number of homes coming to the market? What's happening?
Well, again, another consistency we saw was more for sale signs, but it was a slower pace in the first 6 months than it was a year ago. We had a pent-up demand, I think, last year in 2025, where the second quarter we just saw a ton of inventory hit the market, and then it just kind of slowed down. What I'm seeing this year is every single month there's been a little bit more, a little bit more, a little bit more. And again, it really was variable across the markets. There were some markets that were 10%, some were 15%, but it was consistent that it just wasn't as strong as it was, but we are getting more inventory. Now flip that to sales pace. The sales pace was not as strong as the inventory pace. We do have more for sale signs in the market than we have buyers buying those. So buyers have more choices. It was 2 to 1. If I had 10% growth in inventory, I probably had 5% growth in sales. And in some markets, some price points, it was less, and some it was more, as you said. But I want to give you a new term to our audience, and I want to tie this back to days on market, and I'm going to call it a staleness penalty. There is a penalty for you to sit and not position that right. Your property becomes stale. And I will tell you that if it's the variable, I'm kind of jumping around a little bit, I started seeing about a 3% variable from what was listed to what was sold. And think about that for a second. If I took a $400,000 house and took 3%, then I've got a bucket of money there that I'm probably going to have to put back into condition, back into repair concessions, or maybe a little negotiation because I got more competition. But if I take 4 times 3, that's $12,000, right? Well, I got $12,000 to play with, but if I sit there another 60 days to 90 days and I'm overprice it, that number doubled. And I found this number, first number I've seen nationally, the cost was $35,000 to go from 60 days to 120 days. That is the average number in the United States that if a seller took that gamble, way overpriced it, and they went from a 60-day success rate to 120 days, it would cost them average of $35,000. And I started running my own numbers here in our footprint of the Southeast, and that number percentage-wise would go from 3 to 5%. Well, now take 5% times 400,000. You see the number starts to very similar, not as much, but it's a penalty, and I started calling it a staleness penalty.
So it's interesting. So one of the questions that I'm going to pose to you later, but I'm going to jump right in because you've given me the great segue into it, and that is, as I said, David Ide, one of our great branch leaders from Asheville, ran in the month of May. He took the number of homes that were sold in all of Buncombe County in Asheville.
Yep.
And if you remember, there were 242 homes that were sold. And he went and he figured out how many of those had a price change versus didn't. And then he calculated the days on the market of each of those. So listen to this. Of the 242 homes that sold, 144 sold without a price change and about 100 with a price change.
Yeah.
The 144 sold an average of 18 days. And the ones that had a price change was 120 days.
Wow.
Well, it speaks to your staleness.
Yeah.
And, one of the things that is so important today is the ability to be educated. And so one of the questions I was going to ask you is, as a seller, what would be the important information you need from your real estate professional?
Yeah.
Well, I know now that I'm going to list my house. I'm going to ask my agent, how many homes in this zip code were sold, and how many had price change, how many didn't have price change, and what were the days on the market. It's about segmenting the listings that are selling. And I think that's really, that takes our business to a place that we haven't seen in a long, long time.
That's right. Well, and one of the numbers I tried my best to look across the footprint, and I'm guesstimating in the last 60 days about 40% of our inventory. Yeah. And that number sounded similar to what you just said, that 40% had a price change. But let me clarify to the audience, that's just one price change. What I don't know is how many had 2 and 3 price changes. And I think that staleness penalty probably starts growing the more you start reducing, because consumers will look at the house and say, what's wrong with it?
Right.
And they've been waiting. So I bet the seller's desperate. Let's make worse terms. Let's make a lowball offer, if you will. There's another trend that I'm seeing that's really not in these stats that I hear over and over from our agents is buyers are wanting more turnkey properties. And so when you see these properties come on the market that are sitting there, it's usually condition issues. There's something magical, and even one of our team members, Hanna, said it the other day. Helen, she said that there's this buyer who will make a full price offer, but then they'll ask for the moon when it comes to, the repair terms. And I thought, yeah, that's actually pretty insightful, because we are seeing a buyer behavior of, I buy a house, I really don't want to spend the next 1 to 2 years fixing this house up. Now, there are buyers out there who will do that, but those buyers want it on the low because they want to invest the money and they'll discount it by that much. But there's another one that wants turnkey. So it's not just about getting the right price in today's market, it's what have you done in the last 6 to 12 months to improve the property, or what do you know that needs to be repaired, and maybe let's address it and disclose it up front and make it part of the negotiation, because it will be a better success. Because if you don't tell me about it, it's going to be a failure.
Right. So I think it's a great opportunity for me to answer a question that I was going to ask you, and that is, as a seller today or as a homeowner today, whether I'm thinking about selling or not, what advice would Gary Scott and probably Tony Jarrett give? And you just hit the nail on the head. That I think that every single year as a homeowner, you've got to commit an investment in keeping your home up to speed. Because what we know is the majority of the, one of the reasons we're having an inventory challenge is baby boomers aging in place. I always say the good news is they're living longer. The bad news is they're not selling their houses, right? And so what's happening is, though, when they go to sell their house, and they've built incredible equity in the last 5 years, incredible equity, and what happens is there's so much work to be done. They're not interested, albeit they've got the ability to pay for it. They don't want to do it. It's inconvenient, right? But then more importantly, the buyer doesn't want to be inconvenienced. And so, one of the biggest pieces of advice I would give right now to everybody out there is, take a budget in keeping your home up to speed. Because how many times have I heard and you heard somebody does exactly what we recommend, and by the time they stage it and declutter it and paint it and carpet it, they don't want to leave. They didn't realize how nice their house was.
That's right.
And so, again, I think part of the home ownership journey.
But that's where I'm going to interrupt you, because that's what you want. If you make it so good that you don't want to leave, then that's when the buyer's going to say, I love it and I want to make you a good offer.
They're going to buy it in 18 days.
Bingo.
And they're not going to hammer you on all the details because it's all ready to go. And I think part of that's just culture in society today.
That's right.
Speed, simplicity. I want to move in. I might buy some furniture. I don't really want to go through the other stuff.
That's right.
And I think that's part of some of the homes today being actually built much smaller. I think people want kind of a good quality of life. So let's talk about list price to sale price.
But before you do, I have a stat for you. So I actually have a number on what we just talked about, and I've never seen it before, and I found it. So this is a United States national stat, that if you own a home built from 2010 and up, you're going to budget about $3,000 a year for upkeep, repairs, conditions, improvements. If you own a home that's built in 1940 or earlier, you might as well budget $6,000 to $7,000 a year. It's the first time I've ever seen that number.
So I'm going to give you a stat that's a Gary Scott stat.
All right.
I always said invest 2 to 3% of the value of your home every year.
There you go. I like that.
A little better than those national stats you just shared from those experts. But think about it. I own a $400,000 house. We're not saying anything quite different. We just got there differently. Because somebody in a $400,000 house, whether it's $4,000 or $7,000, if it's $800,000. So the year it was built is important, but also the price and the size. And so if you think about the budget, I just do a math problem. I have a $400,000 house and I'm going to spend $8,000 a year. And if I know that if I spend $8,000 a year, 1 year it might be $12,000, 1 year it might be $2,000. I lived there 20 years. Now when I go to sell it, my realtor's not coming in and saying, do this, do that. Why? The roof has been maintained.
That's right.
Why? Hot water heater's been replaced.
That's correct.
Why? I've painted, I've carpeted, I've had I'm a big believer in every 3 to 5 years you get a home inspection and you fix all the dry rot wood that might be on your windows.
That's right.
There are things we can do while we're living in the home.
That's right.
To prepare the home for sale. And I think we miss that a lot in the communication journey with homeowners.
That's right. And guess who loves it more than anybody is your neighbor.
Yeah, for sure. 100%.
So list price to close price ratio, you asked me. I will tell you, pretty healthy. It actually increased a little bit in the second quarter across the board simply because more activity, more sales activity. Around 97.5%, which I find very healthy. So if I list a house for $100,000, I'll be able to get 97 to 97.5. If I start reducing it at least one time, it starts dipping down to about 96. But in some markets, I saw it dipping down to 95. And it just, like you said, hyper-local, but you need to know that number. And I think that ties back to our staleness penalty that we talked about as well.
So we talked a little bit about a staleness penalty. I think one of the things that is really important is, one of the goals of our podcast is to educate the consumer, both the buyer and the seller. Mm-hmm. And one of the things that I think about a lot, and I heard it today on a call, what is the strategic listing launch when I go to take my property to market? Mm-hmm. And so one of the things is we're not trying in our communication of data to talk sellers into not trying to maximize their return.
Right.
And I just want to make sure that I kind of provide a disclaimer. We're just suggesting that there are things you can do to get more money for your home.
That's right.
And that if you want to maximize that, part of that onus is on you, the seller, and a huge part of it is on us, the realtor. One of the things we've done recently that has been with great success is we've had twilight open houses. Mm-hmm. Historically, open houses, Saturdays, Sundays, but I think one of the things you have to do different things in a different market to get different results. And I think we've gotten great input, whether it's Wednesday night or Thursday night, 5 to 7.
Yep.
People want their weekends. People want to go spend time, it's in the summer.
Yep.
But boy, we're getting activity. And again, it's just about being creative in our solutions, because our job is to maximize the return and maximize your sale price.
That's right.
So I want to make sure that as we talk about things like staleness, things like price changes, it's not to scare anybody, but it's also a reality check that our job is to help you meet your goals and objectives. And if you're getting your home sold for the highest price with the least amount of inconvenience, and that's what we've been doing for 40 years.
Agreed.
So I have a clarifying question.
Yep.
Percent list to sale price. When you look at market data that would come out in an MLS, does that data represent the last listing price, the original listing price? So when I pull up a report from Canopy,
right,
and it says in Cabarrus County, the average percent list to sale price is 97%.
Yeah.
Is that from the last listing price or the original listing price?
The original list price.
Really important stat.
Yep.
And again, it's about understanding the data that you have, because I think in my experience in another market, it was the percent to list price of the last price.
One. Interesting.
Right? Only because it could have gone from broker A to broker B, could have been off the market for 3 months, that kind of thing.
Well, starting from the original gives you a true picture
100%.
of what happened.
I think it's the most important.
Now, I have seen some houses hit the market and then they come off the market for 60 to 90 days and come back on the market at a different price. In that case, it would be on that new price. That'd be the only variable I could see in that scenario. Yeah.
Cool. You got some stats here. Again, we're not going to touch them all, but I came upon this stat here at the bottom of that page that kind of caught me. One of the things we've talked about is we're in a unique time in the history of our industry.
Yep.
And that is, for the 4th year in a row, we'll be at the exact same existing home sales.
Yep.
And I've gone back 40 years. Yes, thanks to AI. Right? In the past, I would have Googled it and I would have figured it out. Today,
right.
AI, you say, give me existing home sales by year from 1980, and you get it.
So you're doing that. I go into my computer. I've kept every record the last 36 years of every stat.
Well, the difference is I'm high tech. I mean, I'm super high tech. Now that I've gotten with Go Bananas AI, Ryder Harris, I'm like an AI guy.
You're 30 years old again.
Yeah, exactly. Yesterday's 60 is today's 30.
Yeah.
So what's interesting is there's not one 4-year period in 40 years
That's right.
where existing home sales have stayed the exact same.
Yeah.
Certainly not at the number they're at.
Yeah.
And you and I started this conversation before we went on air. Even at 4 million existing home sales and another 650,000 new home sales, there are 13,833 homes sold every day.
Yeah.
So regardless of what you read, regardless of what you talk about with someone at a cocktail party, people are buying and selling.
Yeah.
People are buying and selling.
Right.
And I know 2 quarters ago, I shared a perspective that says At 4 million sales, that's when people are buying and selling because there are events in their life that are requiring them to do it.
Yeah.
When you go to 5 million, it's because people are making choices, and maybe that choice is based on an interest rate. Maybe that choice is based on an expanding family. But I think one of the things we have to be prepared for is, or ask the question, is 4 million the new normal?
Yeah.
And it's still 13,833 a day. Lots of homes being sold, lots of buyers and lots of sellers needing the representation of a professional realtor. So talk about some of your, you talked a little bit here about interest rates, and then you've got some really interesting stats about life events that we have to understand and take into account when we talk about the strength or the weakness of the real estate market.
But to your point, what we consider a healthy balance every year? And it's been 5 million was for over a decade. And so your question, is it the new normal? It sure feels like it.
Yeah.
It also goes to another stat we're going to talk about later, a monthly supply of inventory, and that's been 3 months now going on 4 years. So is that the new balance?
You're right.
And I connect both of these to this. I think the world completely changed in 2021 with the pandemic. So we had one event that changed a lot of things. It changed mortgage rates for a lot of people. We hadn't seen a mortgage rate that low since 1970. You started seeing people refinance their homes, or they went and started buying. Then you had a workplace that changed with virtual work. So now I've reinvented my house to live and work at my house. And then the world in the last 2 years has started changing again, which is causing people to rethink maybe I shouldn't have bought there, or my needs have changed. As we always like to say, life gets in the way. This last 2 years, we have seen I've written these down, 7 million babies were born. Usually people buy or sell a house when, especially the second and third baby is born. 7 million people turned 65 years old. 4 million people died. 3 million people got married, and out of those 3 million, half of them got divorced.
Well, wait a minute. Not of those that got
Not those
married
same
that
people,
year.
but 1.5.
I'm just confirming.
Yeah. Well, it could be.
I mean, that would be a whole different podcast. If you don't make it a year.
Yeah, right?
I'm clarifying your data.
Well, it didn't connect those dots, but 3 million people got married, 1.5 million people got divorced. Well, there are 5 things there alone that probably would trigger somebody to change their housing needs.
Yeah.
And that's just 2 years. But what's happening now is a bigger picture is affordability, and we're starting to see a different landscape of that 5 million to 4 million. Unfortunately, there is a first-time home buyer that's sitting on the sidelines right now. I think we're going to talk about some generation stuff. But this last year, it was 12% of all our sales were first-time home, which was an all-time low. It was a 40-year-old age, which was an all-time high. And so we're trying to figure out ways to help people get into houses, because if I decide at 35 years old I'm not going to buy a house, I'm renting, I'm making a life decision, but it's going to cost me when I turn 50 and I have no equity, no asset, and so there's those decisions. I actually think that 4 is maybe our new normal, but I have this confidence that I think we're going to see this evolve a little bit more as these life changes happen. Mm-hmm. I think it should go back up.
Yeah.
There was a projection that maybe we get to 4.2, 4.5, but now we've got this, I've said it earlier, we've got this global conflict that's happening that keeps stopping and starting, and that is causing some disruption. If that would get settled, I think we'd see that 4 million starting to go up again because of all the other factors around it. We heard our good friend Mark McGoldrick say it earlier in a meeting today, and I've heard it, that wage growth is outpacing housing inflation right now. That also has a big impact on people deciding to buy a house. And if that trend continues, which everything says it will, I actually think that could jumpstart some more people buying a house as well.
Well, and I also think that the baby boomers putting their home on the market inevitably will grow.
That's correct.
It's a math problem. It's a number. It's going to happen.
Right.
And one of the things that we educate our sales professionals on is, make sure you're staying in touch with every one of those people that they're going to. It's not a matter of when they sell their home.
Yeah.
Or it's not a matter of if they sell, it's a matter of when they sell it. And what can we do to help them, as we discussed earlier? Prepare for it on the journey.
Yeah.
Don't wait. I think I'm gonna piggyback a little bit on the stats you gave, because I think perspective. You talked about 40 years old was a first-time home buyer, 12% of active sales or actual sales. Historically, the percentage of first-time homebuyers was in the low 30s.
Yeah, exactly.
The average age was in the low 30s.
Yeah.
And so I think that if you didn't know that as where we were, 40 and 12 may not mean anything. So here's my question. We've talked about appreciating home values from 2017 to 2016 to 2026. I know for 5 years, from 19 to 24, it was 54, 57%.
Yeah, right.
So my question to the 40-year-old that just bought their first home, what did it cost you to wait 10 years?
That's right.
And I've read a number, equity buildup of over $127,000.
Wow.
So what's interesting, and this is one of my questions I threw back to you either last night or the night before, was I was in an economic development meeting with the Gaston County Economic Development folks, and someone asked me a question. What advice are you going to give to Gen Z?
Mm-hmm.
And I said, here's my advice to Gen Z. I want you to be like a boomer, not a millennial.
Mm.
I want you to buy like a boomer bought.
Mm-hmm.
Build generational wealth. Figure out a way to find the right mortgage program. Buy a property.
Yeah.
Because if you look, the millennials lost $127,000
Yep.
on average if you waited.
Yeah.
Where the Gen Z, let's figure out a way to get that Gen Z not to wait till they're 40,
Right.
but to buy at 24, 25, 26 and begin to build that generational wealth that us boomers aspired to at the highest level, back 50 years ago.
Well, and let's piggyback on that, because I will tell you, there is a concept at that age that you want to find the perfect house that meets all your lifestyle. Don't. Just buy.
Right.
So maybe buy a 2-bedroom, 2-bath. Maybe buy a 1,200 square foot. Own it for 5-6 years,
Mm-hmm.
improve it, make money, invest that, and go get that 2,000 square foot home as you have children. Don't wait, get into the market and then work your way up, because it's amazing. I think the average tenure of a homeowner today is about 10 years. So start thinking about, if I got in the market and bought a home and kept it 8 to 10 years, and I'm 35 years old, you got a few more houses in your career.
Right.
So start somewhere versus I've got to get that perfect. And I've heard that with your question about the generation there, is maybe it's time to sacrifice some of those things just to get into the market and then work your way up.
Yeah, well, it's interesting because one of the things I'm encouraging all of our agents to do is every week make 2 calls. I want you to make 22 calls. I want you to call a baby boomer and go out and do a real estate review.
Yeah.
And I want you to call a renter and educate them.
Yeah.
Because if I sat with Tony Jarrett and you walked me through the economics, like I'm listening to my friends. My friends aren't buying. So, then I'm not going to buy. And yet the average homeowner, 9 to 11 years in the same home.
Yeah.
And, if I buy it at 200 and I sell it at 220, and we've gone through this every time, it's not, you got to remember the return on your investment is based on the amount of money you put down, not the appreciating home values. And that really, I think people get caught up.
That's right.
A 3% increase in purchase price or in sale price is a much greater growth based on the 20% I put down.
Well, and think of one other side benefit that we haven't even discussed. That is, if I build that asset and get the leverage to get that equity, well, what about my income taxes? What about my state and federal? I mean, buying a home, and there is some tax breaks for doing this, and renters do not get any kind of tax leverage with their rent. They lose. So now every year, we're talking about just the equity in the home, but what about your income and the income taxes that you're paying? Why not leverage that asset to help? It's amazing. It's kind of like marriage. I've heard people who say, we've been dating 10 years, I got married because it's a better write-off on tax. It's the same buying a house, so why not doing it? One thing I do want to show...
I'm just going to say that's the first time I've heard that analogy.
It's a running joke and not miles. So now I will tell you the other thing is 4 million sales. Let's talk about the new construction real quick.
Please.
Because new construction home builders are floating right under 700,000 a year for the last 4 years in a row
Exactly.
as well. And so you have this equity in both new construction and resale that for the first time that I think I've seen in 2 decades, that those two industries are in line with each other. On one, meaning in 08, 09, when the world collapsed, builders collapsed because of the financial. And then residential went way up. Well, now they're running parallel to each other. And the challenge that we have there for our listeners is really not just affordability, but efficiencies in the local governments. All our builders and clients that we talk to say, my father used to say, I am proud to build a house and turn it in 6 months. I don't know many builders can do that anymore. And it's because of all the red tape that they have to go. And I know there's a lot of discussions right now happening in our local markets about trying to help change some of those rules so that builders can build quicker, because we do need that inventory.
Well, that and the market is so fluid. So what happens is I buy a piece of ground based on market data, market stats, housing industry that I know. By the time I can deliver the home, I've gone 18 months or 2 years, and a lot of things have changed. I may have bought the property at a high price, and the home price is stable. I'm not going to say went down, but they stabilized, right? And so, like anything, we make assumptions, but the time frame. When I sit at Cabarrus County with the economic breakfast with Team Honeycutt, there's always builders, and they raise their hand. And they say, if the local government and local municipalities would help us, because every time they put a charge on us, we pass it right on. And it becomes an affordability challenge. Let's talk a little bit. I'm going to shift gears. We'll come back to some of the other stats. I think one of the great values of our company, one of the great benefits of our company is, we're built to give the consumer the ease of a complex transaction. I'm not going to tell people that buying a home is not complicated, because it is. There are a lot of moving parts and pieces. And one of the things that our company did almost 4 decades ago is understood that if you added what we call essential services to the offering, mortgage, title, and insurance, we can make the transaction easier for the consumer and easier for the real estate agent. And whether it's mortgage, whether it's title, or whether it's insurance, one-stop shopping, as we've always said, with choices. And NAR, as you know, it has done a survey every year for the last 30. 80 to 85% of every consumer, when given the choice, how would you like to go to one place, not 4? 85% say one place.
That's right.
And so let's just spend a minute on why. I think one of the things that's really important for our listener, and again, when I talk about essential services, it feels very much like a buyer-driven benefit. It's a seller's-driven benefit. Because if I have my home listed with Howard Hanna, and the buyer comes in with Howard Hanna, and they're using the partners that are affiliated with us, there's security in that transaction that may or may not, I'm not suggesting it doesn't exist, but I can assure you that it does exist. So to tell a little bit about why, from your vantage point and from your perspective and the roles that you play, why is it so important for essential services to be an essential part of the transaction?
A few levels. One level is success. When you have one source of information from one company that's helping me with all those lines of service you described, the control changes versus me chasing people down in other parts of the world. So the control and the efficiencies of that enable me to be more successful as a client, whether I'm a buyer or seller, to get to the closing goal, which is to buy the house or sell the house. 2, I think the convenience of it turns into building relationships with people who are going to help me in the future. We always think about the real estate transaction today, that you're going to get me an insurance policy, for example. When I started, and probably when you started, insurance policy was something I taught the day before closing. I got my insurance policy. I would buy the house. Let's pretend I'm closing July 31. Probably July 30th, I'm calling the insurance. I need a policy. We can't do that anymore. And insurance has gotten pretty complex. And so do I trust that person who's going to help me? I need to do that at time of offer, quite frankly. Because today it's about a roof. It's about a flood zone. It's about some kind of disaster that happened nearby. Whatever it is, I've got to have that advice to make sure, what's the policy on this? And can I get coverage? It used to be coverage was easy. Now there are certain areas in the world where insurance availability is bigger. Can I even get insurance?
Well, and the age of the roof.
And the age of the roof is a big one that's become in the last few years. So an interesting stat from the year 2020 to 2024, the United States experienced 23 natural disasters, whether they were tornadoes, hurricanes, that cost $1 billion or more. 23. The 4 years before that, it was 15. And so insurance in the last 2 to 3 years has experienced a pretty dramatic increase in premiums. What's good is this, our insurance rep, if you're with us, what they're doing is they're calling you the next year and they're shopping for you to make sure, one, you have the right coverage. But what's become a big conversation for our clients recently is the deductible. Which you and I have said, I've heard you say this a lot, the skin in the game. Mm-hmm. And if you have more skin in the game, your premium's going to change, meaning that I don't think a lot of our clients have even looked at their deductible. They're probably all around $1,000. Why not move that to $2,500? Let's just pretend you have a $500,000 house. I would think a $2,500 deductible would be affordable for you. It can dramatically change your premium, and you're going to get that money back every month. And so that's our insurance reps, in my opinion, almost financial advisors in today's world, because they're giving this advice to our clients. So it's really important to shop it, make sure you got the coverage, and make sure you're getting on the return on the premiums you're paying now. And I think it's a bonus for our team to do it. And then last but not least, I think between the three of them is the convenience of having a good experience. Because often when you're working with people who don't know each other, meaning those departments and different firms, sometimes it's running through red tape to get stuff, and we make it seamless. Now, I'm not saying we never have a challenge from time to time,
sure,
but I think it really improves the experience. We call it the full client experience, and it's optional. People can not do it, but the ones who do rave about it.
Yeah, I think we saw the other day that, or today, of all the mortgages that Howard Hanna Mortgage did here in the Carolinas, 27% used of those transactions used both title and insurance in addition to mortgage, right?
Yeah.
One team, one dream. But I think the other thing, you brought up a stat a couple minutes ago where the average homeowner today stays in their home 9 to 11 years. When you and I got into the business, that was 4 to 6 years.
That's right.
So everything shifts, everything changes. And if I give one piece of advice today for a homeowner, maybe more important than investing 2 to 3%, if you have not gotten what we would call an insurance review. Now, yes, do I want it to be Howard Hanna Insurance? You bet I do.
Of course.
Regardless. As a matter of fact, I'm going to make an offering to anyone listening, even if your insurance is with someone else. Call your agent with us, get one of our folks, no obligation. Because to your point, when you get an insurance review, which I just had one, it is eye-opening.
Yeah.
And the variable, I always say the variable in the Petri dish is risk reward and the deductible.
Yeah.
And do I have a balloon? And do I make sure all my jewelry's covered? And I think, it's just something, think about this for a minute. If I bought a home in 2019 and I got insured in 2019 and I have not done a thing with it, I'm highly confident I'm underinsured. Because my home price is up 58 to 62%.
Yeah.
But all my replacement value is based on another time and another day. So we recommend an insurance review annually, but at minimum, every other year to every third year. And again, it also helps us stay connected and bring value to that homeowner who does use our Howard Hanna agent to buy and sell.
And I put the variable in this, and the words would be peace of mind. So instead of me receiving the insurance bill and freaking out, what if my rep reaches out to me first and says, here's going to be the bill, here's the analysis I've done.
Kidding.
And so there's a value and peace of mind with that, and that's what our team does.
So one of the things, Tony, I don't want to get too deep, but one of the questions that popped up is, industry trends over the past 2 years, it is wide open.
Yeah.
And so, let's just talk about, and the way I would characterize it is there's a fair amount of uncertainty based on some mergers and acquisitions. And then I would say there is a significant amount of certainty with us. Mm-hmm. And again, we always think about what are some points of differentiation. So a couple of questions. Let's just go rapid fire. What are some of the things that have happened in the last 2 years from an M&A? Like who did what, who bought who sold to who? And then, what does that mean? What is and here's the most important thing. What does it mean to the buyer and the seller? That's the most important thing.
Yeah.
So take a quick review, what's transpired, and then kind of what your view of it is, and how we can continue to, I call, have poise in the noise. Let's make sure that we have composure and poise with all this in the news about mergers, acquisitions, integration, single platforms, et cetera.
Well, it's happening on both sides. I mean, we've seen Rocket Mortgage by Redfin. Redfin being a virtual real estate company. They were based out of Seattle, Washington, I believe, when they started. Rocket Mortgage bought a real estate company. And then they went and bought a company called Mr. Cooper. And Mr. Cooper is the largest mortgage servicer in the country, meaning that when you pay your mortgage bill, you're paying it to you go online, you pay it, they're managing that. And so what Rocket decided to do is try to create an ecosystem, if you will. And that was the first big missile over the bow, if you will, the first one about 2 years ago. And then we saw a company called Compass buy Anywhere. You probably can speak better to this than me, but Anywhere is a number of brands, including like Century 21, Coldwell Banker. And so they bought that, and that's sitting on the sideline, and we thought that would go through some federal regulations and review, and it was pretty fast. And so that's happening, but that's a company now managing a lot of brands. We just saw this last week, Keller Williams acquired a company, a team. I think it's Joshua Mitchell.
Yeah, it's Team Mirage. It's a lead. Yeah. It's a lead management lead generation company.
Yeah. So we're just seeing it everywhere, and I think what's happening is it kind of relates to what we were talking about earlier. In my opinion, you had COVID. You had some of the best years we ever had. Now you're resetting at a 4 million, and the world has changed. I think a lot of these companies are looking for scale. They're looking for market share, and they're looking for everything you just and I talked about that we already have, which is all these family of companies or central services, because of the diversity of the income. When one department's down, another department's up. And so there are a lot of companies. Now, I go back to where we started, and I'm thinking if we owned our own companies today, this would be a challenge right now. I need a mortgage company. I need an insurance company. When we started, we didn't need all this technology. Now we need technology. We need scale. And then who are you going to talk to? I'll never forget when we sold our company to Alan Tate. I remember it was 3 of us sitting in a room trying to figure out the world, and then we walked in, and I remember you led that meeting. There were 60 people, and I thought, oh my God, I want to be just like you. I want to be like you. Suddenly I had all these resources. And I think it's changed again that people are looking for these kind of things. And some of the conversations I have with people are just, I don't want to lead and do all this anymore. I want to go back to where I started, which is helping clients out in the field and sell. And so what's interesting, the most interesting fact for me of watching all this is that when we started, there were a lot of small, family-owned, independent companies. And today, we're, in my opinion, the outlier. We are the only independent and family-owned in the top 10 in the United States. And when we sold, we wanted that scale. We wanted to be able to provide our agents and our clients more services, more products, a better experience. Not that we couldn't when we were small, but the bigger we got, the more, because I'd have clients call me in Greensboro and say, hey, can you go help me find that house in Burlington? Can you go help me find that? And I couldn't at that time. But as we grew, we could. And I think a lot of agents are starting to, as we see geographic areas blend in together, you need that reach. But what's interesting is it's Main Street versus Wall Street. There are so many companies now that are being managed by venture capitalists. I'm trying to make money on the stock market, and performance has got to be much different. Not that our performance is not as good, but we can manage it much more intimately with personal relationships where that's not as personal to me. And it's maybe it's night and day. I don't know if that's the right word, but it feels a lot different from just 3-4 years ago. What do you think about that?
Well, so I think
that was a lot.
So a couple more, right? Real buys Remax.
Yeah, right? That was the other one.
EXP buys Next Home and changes their name. And what's so interesting to me is every single press release was nothing's going to change. And I'm reminded, a colleague of ours, Matt Good, his father, Mike Good. Mike was in the NRT and was one of the great pioneers and architects of great growth, and he must have bought 100 companies. And I learned a valuable lesson from Mike Good. He says, when you stand up and buy a company, you say, most companies tell you nothing's going to change. I'm going to tell you right now, everything's going to change.
You're right.
But everything's going to be better. And here's my observation. My observation is that as these companies grow to a scale that is, I'll call it from a numbers perspective, one could argue extraordinary, right? I think the consumer and the agent is becoming a number. That's my opinion. I've been doing this a long time. I think the one value that we have is, yes, we have size and scale that enables us to do things that the Alan Tate company by itself couldn't do, the Rand company by itself couldn't do, the Coach company by itself couldn't do, FC by itself. but we have not forgotten our roots.
Right.
That is one of the most compelling conversations that I believe in, is every agent has a name, has a family, has part of our culture, it's part of our DNA, and every one of our customers. And I think we've got this incredible blend in my view, and again, I'm biased because I'm here, but we've been able to get scale without giving up what sometimes has to be given up when you get scale.
That's a good point.
Right? And we talk about it all the time. How do you make a big company feel small? You can make a big company feel small by caring deeply about the people that you work with and the people that you represent in the transaction. And as you grow, it gets harder and harder. But I do think, and as you and I know, certainly led by the Hanna family. They are 3 generations passionate about this business like nobody's business. I've never seen anything like it in terms of having conversations about listing contests and daily 7s and Ninja 9, and that's all about helping our agent be successful.
Right.
And I think that's a real differentiation. And as we think about looking in the rearview mirror for the second quarter and the third quarter, all of this uncertainty that is out there with these companies that you and I just discussed, I always say the more uncertain they are, the more certain we are. And what I know about uncertainty is uncertainty creates fear, creates speculation. Certainty creates confidence and belief. And I do think that's a differentiator. And I think as a buyer and a seller, I want to be with that real estate partner who's in an environment of great certainty, because the transaction is pretty darn complex, as we said earlier.
Well, and when you think, your word culture is really important, because as the world has turned the last few years, and a lot of virtual companies have taken off in some of these mergers because of the business model, and quite frankly, I went to Chapel Hill Business School, and there was a word called profit, and profit margins are shifting. But what happened is when you create profits and you go too virtual, some of the people that have come to us and said, hey, we want to talk to you about your company, is because they don't know who their leader is. They miss the ability to walk in an office and go to a business meeting or have sessions where they exchange information. I always call it osmosis, where you learn from hearing other people. And there is a big need in our industry to have some of that. And we always say we're brick and mortar, but our brick and mortar looks different than it did 20 years ago.
Sure.
But when you come into an office, you can feel it. And there are days when everybody's there and you feel that energy, you feel that information, you know who your buddies are that you could talk to. It's like when I walked in that room with you and I saw 60 people, I suddenly had 60 new friends that when I was in trouble, when I needed help, I knew who I could call, somebody could coach me, somebody accountable. And I'm worried that some of these companies don't have some of those options for people. And I'm hearing more people asking for that. So it makes me feel really good about who we are, what our position, and you hit it on the head. It's that culture.
Well, what's interesting is you and I just took a look at market share, and I'm going to keep some companies in the witness protection program, but some of the virtual companies that don't have community, as we look at what's happening to market share, they're losing some share.
Yeah.
There's a human need to be with other humans. It's part and parcel. And COVID took a pretty fragmented industry called the real estate business, where my father used to say, what are you doing in the office? You're not selling any houses. You got to get out, right?
Yeah, right.
So the more you're in the office, the less you're with people, but it's all about that delicate balance. And it's funny, you talked about profit. One of my other favorite things my dad used to say is never apologize for one, right? Because everybody's got to make some money. I think the beauty for us, from my perspective, is we want the consumer as a seller to maximize the return.
Yeah.
We want the buyer to be represented so they have a seamless transaction, so they can begin building the wealth that real estate can do. And then we want to make sure we provide a culture and an environment for the agent population. I just read a stat. I think the first 66 months of 2026, did you read this stat? 86% of the membership at NAR has not sold a house in the first 6 months.
No, I hadn't seen that stat.
Now, I don't know if it was fact or fiction.
Yeah.
86 sounds like a high number.
Yeah.
But let's say it's 66.
Yeah.
Let's say it's 76.
Still high.
It's still high.
Yeah.
And so, one of the challenges is, there's very little barrier to entry into our business.
Yeah.
And there are a fair number of agents who are good with 1 or 2 deals. I always joke, I say, I had a hip replaced 6 years ago, and I wasn't going to get a part-timer.
Right.
Like, I wanted a full-time guy who that's all he did.
Yeah.
Like, I didn't want to, like, I don't want you, serving bar and then coming in and replacing my hip. And I know buying a house isn't a hip replacement or heart surgery. It's super important.
But to your point earlier, if I only do it once a decade, and
Super important.
and it's really important financially to me personally that we do this right. I think you want that expert, like you described.
Yeah. Well, anyway, so let's kind of recap. We're coming on an hour, and you and I could talk about this for the better part of 2
hours.
The better part of 2 hours. But I think we laugh because everybody, not somebody, not everybody wants to know about the housing. Like, it's on top of people's mind. You and I are wearing some new pins. And you walk into the Harris Teeter and people say, "Tell me about the real estate business." Guys, here's what I heard.
Yeah.
And I love your line when they ask you about it. Say, "What have you heard?"
Yeah, right.
Like, what have you heard?
Yeah.
Because no sense in me either being a proponent of fiction,
Right.
My ability to attack fact. So I'm going to ask one question about today's home buyers and one question about today's home sellers. I'm going to wrap a bow around it by a little prediction for the balance of the 6 month. I'm going to try to picked 5, and some of them we've talked about. If you could give every buyer who's actively buying just one piece of advice before they begin their home search, what would it be?
Get pre-approved. Make sure that your finances are ready and when you present your offer, present that approval. There's one thing about being pre-approved, but the word approval, there's one thing about, you look good, make sure it's certified approved, it will strengthen your offer. Because if you were to find that house in the right price point and suddenly you're in competition with somebody else buying it, you're going to win because of that pre-approval.
Well, I think the other thing, Tony, is how many times have we heard somebody say, "I'm just going to go poke around at an open house.
Yeah.
I'm curious." And in a weekend, curiosity goes from I'm curious to I'm motivated and I'm inspired.
Right.
So the minute I'm going to take it one step further. From the minute you begin to consider maybe buying a house, like not when I've decided to buy a house. If I'm going to go look at open houses, as much as I say I'm just window shopping, get ready, understand. Because the other thing you'll learn is here are 7 things you've got to do to prepare yourself to get a mortgage, because maybe you've got some credit coaching or things like that.
Right.
I'm 100%, and I'm just taking it a step further. And I think the other thing about a home buyer is, and we talked about it a little bit, is, we've got Howard Hanna Mortgage, and, we've got a great program for someone who owns a home, who's got to sell a home and buy a home, called Buy Before You Sell. And basically it's about preparing me to go in with a cash-like offer, albeit I've got a home to sell.
Yeah.
And so, again, there are mortgage programs out that we offer that help you strengthen your position as a buyer in a competitive world.
Let me add one other commentary to this that I'm seeing that I would encourage all of our buyers out there is don't believe 100% of everything you read in ChatGPT and Gemini about what you're reading about the house.
Great idea.
I'm really concerned because you really need to put in a lot of information into artificial intelligence for it to be intelligent when it comes back out. And if it's just one comment, one question, and it becomes your belief system because ChatGPT or Gemini said it, it may not add up to reality. We're starting to run into that. I really believe buyers should use it as a resource if they so feel, but they really need to lean into that professional, that Howard Hanna, Alan Tate, Howard Hanna, beverly-hanks agent, and Howard Hanna agent who knows the market, because they are your artificial intelligence, if you will, versus a computer that hasn't been in the house, hasn't walked through it, doesn't know the comps. It's just concerning that this is becoming a challenge for a lot of our team.
I love it. I can't believe we didn't bring up AI. AI is agent intelligence, right? We've talked about that.
I love that. I love that. Agent intelligence. We just rebranded the whole thing.
Well, so Matthew Farrar, one of our great national speaker friends, just did a reel. And he said, I do not use AI to complete my tasks. I do not use it to do my work.
Yeah.
I use AI to educate myself.
Right.
And when you think about what you just said, remember our good friend Ryder Harris, Go Bananas AI, we love that guy, been a huge friend of our company. He told the story about an attorney who was going to prepare a brief, and he used all AI. And he went into the courtroom and he presented the brief to the judge, and every case he had referred to was done incorrectly.
Yeah.
And so the other comment a writer had, which I would ask everybody to think about, is he said, no one uses AI more than I do, and no one questions its accuracy more than I do.
Right,
So,
right.
Great bit of advice, because one of the things we're trying to educate the agent is make sure you know what AI the buyers and sellers are using so that you can preempt
Bingo.
it.
Bingo.
And so there's a whole nother set of, whether it's data points or information or preparation, whatever you want to call it, AI is not going to take me and you out of business. AI, if we use it right, is going to make us more effective and more efficient and do some of the tasks that we haven't been able to do by ourselves or that. So I'm going to flip it over. What advice would you give homeowners who are thinking about selling but are waiting for is there a perfect time?
No.
Is there a perfect time?
No, there's not. Yeah, there is a perfect time when it's right for you.
Amen.
When it's right for you in your life. That's when you should do it. Not because it's the spring market, not because it's the fall market, not because you've seen a headline that says prices are up. It's when you are ready to do what you need to do in your life. That's the perfect time.
Right. You know, it's interesting. Do you know houses are sold in December?
Whoa, no, I've never heard that.
Yeah. Well, I'm going to wait. I love, here's my favorite. You're talking to a seller in October. Well, I'm going to wait.
Yeah.
And I'm going to say, I wouldn't wait.
Yeah.
Because two things. Number one, there's going to be less competition.
Bingo.
And let me tell you, the buyer in November, December is a buyer.
Yeah. And quite frankly, I have worked with buyers who intentionally wanted to buy a house as a
course.
Christmas gift to each other. So why not have that?
You're full of a bunch of nuggets today. You know, you had 3 million people married and divorced, and half of them got divorced in the same year.
Who knew?
Yeah, again. And you've taken AI from artificial intelligence to agent intelligence.
Well, I took that from you.
Yeah, well, anyhow, Tony, great to be with you. You know, we're excited about the balance of 2026.
Yeah.
Yeah, you know, you talked about the February 27th, and you talked about the war. One of the things I tell everybody, there are distractions and disturbances every single year.
Yeah.
It's how we respond and react to them, and how we better educate and better prepare ourselves as agents and consumers
Yeah.
to take. There are opportunities out there that are limitless, but you got to search for them and you got to educate yourself about them.
That's right.
And they got to have a little courage to pull the trigger.
Well,
right?
and to your perspective, I will tell you that 2 years ago we saw 8% mortgage rates. And then they came back down to 6. And even with this conflict that we have that's started back up, we're still not back up to 7. We're still in the 6s. So it feels like we're going to stay in the 6s, should be in the 6s, and that has been historically in my career a very healthy number. So great perspective on that.
There are more mortgages today over 6 than under 3.
That's right.
And very few people believe you when you say that.
Yeah.
And let me just give a recommendation to the renter who is waiting for interest rates to go under 6.
Yeah, it's probably not going to happen.
Well, currently you're paying 100%.
Hey, bingo.
And I know that's cliche, but it's not,
Yeah.
right? And you know, 6.5, 6, and you know, you and I laughed a couple quarterly updates ago. I think my first loan was 9.875, and you would have thought I won the Powerball.
Yeah.
You know, and then now I have one at 2.5. Yes. Will that be a hard house to sell? It won't be a hard house to sell. It'll be a difficult house to sell. But life circumstances might require it
That's right.
to be different.
That's right.
Anyhow, TJ, always a pleasure.
Always.
Great having you
Thank
on,
you, buddy.
on the Quarterly Update.
Enjoyed it.
And Reality Podcast. I want to thank our listeners. And it's about real people, real experiences, real time. And it's about the real estate business.
I wish everybody out there a real happy summer.
Let's do it.
All right, buddy.
See you in a couple months.
See you.
Take care, buddy.
Bye.